The money you think you own isn't really there. That's not a metaphor, and it's not a conspiracy. If everyone walked into their bank tomorrow and demanded their cash, the entire financial system would collapse in hours because the money simply does not exist. This isn't a bug. This isn't a mistake. It's the design. A centuries-old trick so deeply woven into the fabric of modern finance that most people no longer question it. It's called fractional banking, and it sits quietly behind global debt, inflation, and the illusion of wealth we take for granted. Once you understand how it works, you realize that money is nothing more than a promise that can never fully be kept. To see where this began, we need to go back long before digital screens and banking apps existed. In medieval Europe, wealth was physical: gold coins, silver bars, jewels. But carrying real treasure was dangerous, so people began storing their valuables with goldsmiths, men who had secure vaults. In exchange, the goldsmith issued a receipt, a simple note promising that the holder could reclaim their gold at any time. Eventually, people realized something surprising. They could trade the receipts instead of the gold itself. The paper became just as valuable as the metal, lighter to carry, easier to use. And that's when the trick was born. Goldsmiths noticed that almost no one came to withdraw their gold at the same time. Out of 100 depositors, maybe 1 or 2 showed up on any given day. The rest of the gold sat untouched, so they got creative. If they held 1,000 coins, they might issue 2,000 receipts. They lent out the extra receipts at interest, earning money on gold they did not have. As long as everyone didn't show up at once, no one realized the truth. It was money, created from nothing. This wasn't a small scam. It was a revolution. The moment society accepted paper claims as good as gold, money creation became unshackled from physical reality. Banks grew out of this exact practice, formalizing the trick. By the late 1600s, governments embraced it too. The Bank of England was founded in 1694 for a simple reason. The crown was drowning in war debt. The bank lent the government far more money than it held in reserves, in exchange for interest, repayable through future taxes. If that sounds familiar, it should. It's the same mechanism nations use today. Borrow money that doesn't exist, spend it, then tax future generations to make up the difference. The United States followed the same path. Early American banks printed more notes than they had gold to cover. Whenever fear spread, depositors rushed to withdraw their money, only to discover it wasn't really there. Banks collapsed overnight. Panic turned into crisis. Instead of shutting down the system, governments protected it. They created central banks to guarantee the illusion. The message was simple. Even if the money isn't real, we'll make sure people believe it is. Now let's translate this into modern terms, because fractional banking today is even harder to see. When you deposit $100 into a bank, you imagine it sitting safely in your account. But the truth is different. Banks keep only a tiny fraction of deposits on hand. Historically, it might have been 10%. Today in the United States, it's 0. Since March 2020, banks are not required to keep a single dollar in reserve. So what stops them from lending endlessly? Not deposits, not reserves. The leash now is something else. Capital and liquidity requirements. Rules written by unelected technocrats under the Basel framework in Switzerland. Here's how it really works. Banks create loans first, and the deposits appear afterward. When you receive a mortgage, the bank doesn't pull money from a vault. It simply types new digits into existence. Your promise to repay becomes the bank's asset. Your debt. Globally, reserve requirements have mostly vanished. From Europe to the UK, Canada to Australia, banks rely almost entirely on Basel capital rules. Emerging economies still use reserve ratios, but even there, Basel rules shape the system. No matter where you live, the truth is the same. The leash on money creation isn't gold or cash or deposits. It's regulation and confidence. And here's the most uncomfortable truth of all. The system cannot afford for you to be debt-free. If every household repaid its loans tomorrow, the money supply would evaporate, banks would stop lending, economies would freeze. Your debt is the system's lifeblood. Your spending keeps it alive. And your belief, your trust, is the invisible foundation holding everything up. This is why history matters. The same pattern repeats over centuries: the Goldsmiths of medieval Europe, the bank panics of the 19th century, the housing bubble of 2008. Different eras, same underlying mechanism. A trick that multiplies promises beyond reality, and a public that believes until belief becomes impossible. So what should you take away from all this? Money is not wealth. Real wealth is land, skills, resources, knowledge. Things that hold value when paper promises collapse. Debt is not neutral. It privileges those who lend and punishes those who depend on the system. Inflation is not an accident. It is built into the machine. Every year you run faster just to stay in the same place. That doesn't mean doom is inevitable, but it does mean you must rethink how you relate to money. Because the next time you check your bank balance, remember, most of what you see exists only as digits. Born from a system never designed with your freedom in mind. Understand the trick, and you can protect yourself from it. Ignore it, and you remain another pawn in a game where the house always wins. If this opened your eyes, hit subscribe. History has the answers, and I'll show you where to look.